Hey guys, my name is Lacey and welcome back to my YouTube channel. Today I want to go over everything you need to know to grow your portfolio and how to be a successful stock market investor. The stock market is a great way to make money, but it's also a big way to lose money if you don't know what you're doing. I want to show you the skills you need to know to become a successful stock market investor. You're going to want to watch this video all the way through because I'm going to give out a lot of good information. All I ask is that you guys like this video and subscribe if you want to see more videos related to the stock market. But with that being said, let's get into it. The very first step you need to take to get started in stock market investing is to open a brokerage account. There are several that you can choose from. Some of the most popular are Fidelity, Vanguard, Charles Schwab, and Ally Invest. These are some of the best because there is a $0 account minimum and $0 trading commissions. Once the account is open and you have money in your account, by electronically transferring funds from your bank account, you're ready to start trading. The second but most important step that you need to take is to research the companies that you want to invest in. There are literally millions of companies that you can invest in, but as a beginner, I suggest that you only invest in companies that you're familiar with or would buy products from. Warren Buffett, a legend in stock market investing, has always said, buy into a company because you want to own it, not because you want the stock to go up. As a beginner, you should only invest in 1 to 3 companies at a time. This is because you need to know the ins and outs of the company that you're investing in. You need to be able to look at a company and know how it's doing financially. The two most important parts of a company is their assets and their liabilities. These are important because it will tell how successful the company is or if it's leading down a path towards bankruptcy. While it is very important to know how to read a balance sheet, you also need to know the fundamentals of a company. Some of the questions that you need to know is, who is the CEO? What is their mission? How is the company adapting to the changes in the environment around them? All of these are important to determine if the company is going to succeed or fail in the long term. The third step is to determine what type of sector you want to be in. The 3 most important sectors in the stock market are growth, value, and dividend. Growth stocks are stocks in a company that can give you a higher average rate of return. These stocks are high risk, high reward. Some examples of growth stocks are Amazon, Tesla, and Square. Value stocks are traded at a lower price than the overall valuation of the company. The way people make money in value stocks is when there are inefficiencies in the stock market that make the stock go up. Some examples of value stocks are Berkshire Hathaway, Walgreens, JP Morgan, and Google. Dividend stocks are the least popular of these stocks, but they are a good way to make money. There are certain companies that will pay you dividends just for owning a share in their company. You can either reinvest that dividend or you can cash it out to pay for bills or whatnot. Some people are able to build up so much in dividends that they end up making more in passive income than they do than their main source of income. It does take quite a lot of money to build up high dividend returns, but if you plan on becoming a dividend investor, you can extend that over a period of time. Some examples of dividend stocks are Pfizer, Wells Fargo, and Realty Income. A good portfolio has about 2 to 3 of these sectors in their portfolio. The fourth step is to determine what type of investor you want to be. There are 2 types of investing, active and passive investing. Active investing is when someone buys or sells stocks in the range between days or months. Active investors' goals are to beat the average rate of return of the market and to take advantage of fluctuations in stocks. It is a very hands-on approach and takes a lot of research and ability to follow the trends of that particular stock. Passive investing is a very hands-off approach. It is a long-term strategy where an individual buys and holds a diversified portfolio for at least a year to not beat but match the stock market. People who usually partake in passive investing allocate a certain amount of money each month and put it in a mutual fund or ETF. This way of investing is less volatile, but it will only give you a certain amount of gains over a long period of time. Each type of investing has its pros and cons, but it all comes down to what you're comfortable with. The last step is to not let the stock market control you. Stock market investing is a very rewarding but long and patient journey. If you're looking to get rich quick, investing in the stock market is not right for you. Depending on your risk tolerance, you often see a lot of volatility in the market. It is important to not let the fluctuations make you sell out of your stocks just because you're down, or to dump all of your life savings into it because you're on a winner's high. Patience is key to being successful in the stock market. If you've done your research and know that the company is solid and it's going to be profitable in the future, there should be no reason for you to sell out of that stock just because it's down currently. Also, it is very important that you do not invest money that you're going to need in your daily life. If you want to have a successful account, you need to let that money mature over a long period of time. Selling out of your shares because you need the money for bills will stop you from making any money that the stock would make if it went up. Also, a big mistake that investors make, and I'm guilty of this too, is chasing a stock because you have a fear of missing out. This means that you got caught buying at a high and then it falling shortly afterwards. You need to be patient in the stock market because there will always be a correction or a pullback in every single stock. It is also very important to have 10 to 20% of your net worth in cash or cash equivalents. This will allow you to take advantage of stocks when they dip, to start new positions or to buy more shares in positions that are already built out. So those are the 5 steps you need to take to become a successful stock market investor. I hope you guys liked the video. Let me know in the comments below if you want me to make more videos like this, and I'll see you guys in the next one.